If you've been following along with the videos, you've noticed there are several kind of separate parts that we've been working on. And what we're going to do in this video is we're going to put all of these parts together in order to do something really profound. And that is to determine if you're better off to borrow money and use that borrowed money to purchase an asset, or if you're better off to simply lease that asset. Now, the way to think about this is that no matter what you do, whether you're borrowing the money or leasing the asset, the money you make from the asset is going to be the same. So we can ignore the revenue side of things and just look at the expenses. So here's the rundown. This is what I put together off camera so that you could follow along. So if you were to stop and plug this into a spreadsheet, that would be the smart thing to do right now. So basically what we've got is this. We have an asset that has a purchase price of $85,000. We believe that we're going to make a down payment of $20,000 for this asset, so we're going to finance $65,000. We've secured an 8% interest rate, and for simplicities, we're going to say that our discount rate for our net present value calculation, our cost of capital, is also 8%. These numbers do not have to be the same. We've got a useful life of 5 years, and we're just going to do this with a 1 payment per year scenario. You can simply make it more complicated by doing 12 payments per year, whatever you would like to do. In addition to that, we're going to imagine that the person doing this analysis faces a personal marginal income tax rate of 27%, meaning every time they earn a dollar, they pay 27 cents on that dollar, or every time they can reduce their profit by a dollar, they'll save 27 cents in their taxes. This asset has a salvage value of $15,000, meaning 5 years down the road, when I'm finished using this thing, I'm going to have destroyed a significant amount of its value, and I'm going to sell this thing for $15,000. And we're going to be using a factor of 1.5 when we do our declining balance depreciation. And if you remember the depreciation video, you'll see how that's done. So let's just jump right into it. The first thing we need to do is we need to calculate the payment. So we're going to use the payment functions, equals PMT, and then open parentheses. We plug the rate in, which is 8%, our interest rate, and we hit F4 so we can lock the cell reference. We type a comma, the number of periods, which is 5, so we click on the 5 in cell B8, and we type F4. Then we have a present value. The present value is the amount of money that you are borrowing. That's going to be our $85,000 purchase price. Hit the F4 key again to lock the cell reference, minus our $20,000 down payment in cell B5. Hit the F4 key again to lock that in. There is no future value on this one. You would use the future value if you had, say, a balloon payment. You were paying the loan until it got to a certain point. So basically the future value is 0. You're going to pay off the entire loan. And the type is there basically for using either an annuity or an annuity due. It's when the payment happens. In this example, we're going to imagine the payment happens at the end of the month. We close that parentheses, we press enter, we get a payment of negative $16,000 and some change. Now what we need to do is figure out how much interest is a part of that payment. To do that, we type an equal sign and IPMT. That's the interest on the payment. So this function returns the interest payment for any given period. Why? Because interest is tax deductible. Interest is a type of expense. Expenses lower your profit. So anytime you have an expense, you get to pay less in taxes. Now, the amount you pay less is never less than the expense. It's never more than the expense. It's always less than the expense. Your tax burden goes down when your expenses go up, but expenses are still bad. You're better off actually making money than you are having lots of expenses and not making money. Just like before, the rate is the interest rate. That's our 8% interest rate in cell B6. Hit the F4 key again. The next one is PER. Now there's two arguments, PER and NPER. PER is 1. This is the first year. So we're looking for the interest portion on the first payment of this annual loan. Make 5 payments over 5 years. Comma, NPER is the number of periods, which is 5. Hit the F4 key to lock in the cell reference. The present value is the amount of the loan, the amount we're going to borrow. So we're going to type a comma, click on the $85,000 in B4, hit F4, and then we're going to subtract the $20,000 in B5, hit F4 again. We close that parentheses, and we should get a number. Basically, what's happened here is you're going to pay $5,200 in interest every single year. Now, just to keep this looking the way I want, I'm going to stick a negative sign in front of that because I want that number to come out positive. And I'll show you why here in a second. Now, next is the depreciation. For this particular method, we're going to use a declining balance method with a 1.5 factor, the 150% declining balance depreciation method. And you can change that by changing the factor. You could use a straight line method. There's several different methods you could use. We type an equals sign and we type DDB, that's double declining balance. That returns the depreciation for a specific period using the double declining balance method. We start by entering the cost. This is how much the purchase price of the asset originally. So we click on the $85,000 and hit F4 to lock in that cell reference. Type a comma, and we need the salvage value. The salvage value is $15,000, which is in cell B11. Hit F4 to lock in the cell reference. Next, we need the life. How long do we plan on using the asset? That's 5 years. So we type a comma and then click on the number 5 hiding out in cell B8. And again, we hit the magic F4 to lock in our cell reference. And a comma again. Now we need the period. So the period is the year or the month or whatever time period we're in right now. And that is period number 1. There's no need for a cell reference here. And then a comma, and finally the factor. The default is going to be 2. In this case, we want a factor of 1.5 or 150% declining balance. So we click on cell B12 where 1.5 is hiding, hit the F4, close the parentheses, and hit enter, and now we have the depreciation. So we're going to depreciate this asset by $25,500 a year. Now comes the cool part. Now we're going to find out what the tax burden is going to be, or rather the tax relief we're going to get, because we have these expenses associated with the depreciation and the interest, because depreciation and interest are expenses. When your expenses go up, your profit goes down and your tax bill goes down at the same time. So we type an equal sign and we click on our marginal income tax rate of 27%, and we hit F4 to lock that in, an asterisk to multiply, then an open parentheses, and we simply add our interest plus our depreciation, and we're going to close that parentheses. Now I'm going to add one more thing. I'm going to add what I call other cash flows. And in this first case, the first other cash flow is going to be our down payment. So we have to stick in this $20,000 down payment. And what I want to do is I want to make that a negative number and hit enter right there. And then I want to add all those up. I can simply use the auto sum function, or I can type equals sum. Well, actually, here's what I want to add up. I want to make that equal to my payment, a negative cash flow, plus the amount of money I save on taxes, a positive cash flow, plus the negative $20,000 that I paid in our down payment. And that's going to tell me how much money I spent, how much cash went out this time. Now, when you set this up, you can set it up so that your payment or your other cash flows display as a positive number. If that's the case, you're going to subtract when you put the formula together. Keep that in mind. You don't have to do it exactly the way I did it, and you can format it differently. So now we're going to press enter. And we find out that the first year we own this asset, we're going to burn just shy of $28,000 in cash on this asset. Now we're going to take this entire set of information, highlight it all, and we're going to drag it down. And we're going to have some errors, and the errors are going to be right here in the other cash flows. So let's just go in and fix those manually. Pretty straightforward thing to do. And in the last time period, our other cash flow is going to be our salvage value. We have $15,000 coming into our business when we liquidate this asset at the end of its useful life for $15,000. So we're going to change that other cash flows in the 5th year from a 0 to a $15,000. And the net result is that very last year, this asset brings us a net positive inflow, right? Now we find the net present value. In cell B21, I'm going to type equals NPV, open parentheses. I'm going to click on my 8% interest rate. I'm going to type a comma. I'm going to highlight my cash flows from years 1 through 5. I'm going to close a parenthesis. I'm going to hit enter, and here's what I get. I get that this asset is going to cost me $53,000 and some change, almost $54,000. After I back out the tax relief I get from all of these expenses. Now, keep in mind, I'm still spending money on this thing. The tax relief is not enough to justify the expenses, but we do the tax savings simply so we can get a good picture of how the depreciation and the interest are going to lower our profitability and therefore lower our tax bill. So that is how we determine the net present value of financing an asset. Now the next thing we're going to do is we're going to pop over to the next tab on my spreadsheet, and we're going to do an example of leasing.